staying out of the way of the response. Good morning, Muser. We're not, hey, good morning, Erla. Not trading what he says, but rather knowing that it can create a reaction is what we're doing here. And then everything that I talk about, guys, I mean, every day we're coming from the education page. You guys can see my screen as well, right? Just want to make sure. It's making me look at both of them, so it's kind of a weird thing for me. Okay, cool. I'm going to take my picture off of there on my side. Everything that you need, guys, every answer that you could ever hope for is coming from this education page. And there's two sections, really. There's the software user guide, and I'm going to click on that one first. And this is really your NinjaTrader how-to. Anything and everything that you need about NinjaTrader is right here, whether it is muting the chat room, that's not NinjaTrader, but closing workspaces, opening workspaces, scaling charts, setting up stops and targets. All that's available to you right here in the user guide. There is also using your screen capture software so that you can take pictures and present in the room, starting over, deleting everything, going fresh. Sometimes it's nice just to do that as well. Building charts, live access, muting the room, screen capture. I mean, anything and everything. NinjaTrader and really Discord related is going to be right here in the user guide. And then the other one is the trading guide. This is all the answers, guys. If you have a question about one of the trades I teach, you're going to find it here. If you have a question about management, you're going to find it here. So the first thing we're going to focus on from the tutorial section, from the trader guide, is here in the glossary of common terms. We're going to talk about a high probability trend trade today. We do this for a couple of reasons. You know, someone asked me yesterday, hey, what's the best trade for a new user? This is it, guys. In my opinion, the high probability trend trade is what sets you up for success. The high probability trend trade is what builds a foundation. The high probability trend trade is going to teach you to read your charts. And a high probability trend trade is defined when each indicator on every chart agrees for the rules of the trade. All your triggers are the strongest. There's nothing between you and your targets, no termination conditions. This is a trade that typically wins 70 to 80% of the time. This is a trade that creates an awful lot of confidence through the memory of success, but most importantly, and I think this is the biggest key on it, is it allows you to learn to read your charts. It puts you in a position to be profitable, to be consistent, while you learn to be a chart reader. And chart reading is about 90% of what we do every day. Some people would argue that it's 95% of what we do every day. It's looking at our indicators, waiting for advantages. Everything is based on a statistical advantage. And then when those advantages are present, when your ability to read the chart says, yes, your rules are met, that's that 10%. That's when we're looking for the trade. So a little bit of study is going to have you understanding where the market is likely to continue. Using that point for entry for the high probability trend trade, it's going to let you understand where the market is likely to go, and this is going to help you set up targets. And then finally, where the market is likely to stop is going to allow you to not trade into these key areas that you see on your large chart, to make sure that you're not trading into areas that could create a reversal where decisions are being made by the people in charge. So we're going to focus on the high probability trend trade. We're going to take about an hour to do it. The first hour is very much a lecture. And the high probability trend trade is only 3 rules, guys. These 3 rules come together, and what they do is they form a trade. Each rule, hey, Zoro, provides an advantage, and it's the accumulation of the advantages that are going to create the trade. So your first rule says strong trigger lines, and strong trigger lines provide momentum. And your second rule says no termination conditions. Those are those likely to stop areas. And when you don't have termination conditions present, you're going to have room to your targets. And when you have room to your targets, we're just going to call that a clear path, right? Simplicity, as few words as possible. And then finally, when you do have momentum, when you do recognize that clear path, you're going to have an entry area where the market is most likely to continue. Hey, Cab, I can see you too. Well, I can't really. I can see your name. We're doing a little video series, and you guys are stuck with me. Sorry. This entry area is the best of the best. This is the point where the market is most likely to continue. I always encourage new users, keep it simple, keep it focused, learn to read your indicators. Good morning, Mr. Flowers. Um, and allow yourself to be able to speak in terms of advantages. This is momentum. This is a clear path. This is an entry area. So we're going to break them each down. We're going to go over each rule. We're going to learn how to study them. And we're going to keep it very simple. Good morning, Jonathan. These three rules happen on only two charts. There is a large chart and a small chart. That's pretty technical, right? Your large chart on the most current bar, um, my brother's trying to distract me with Skype. This bar right here on this broad stroke of a brush is going to define direction, momentum, and areas. Direction is the easiest lesson that you're going to get today, guys. If the background is green, the market's going up. Let's look for rules to be met for high probability trend trades long. If the background is red, the market's going down. Let's look for rules to be met for high probability trend trade short. Let's keep ourselves on the right side of the large chart. Rules 1 and 2 are met on the large chart. Rule 1, remember, provides us momentum. Rule 2 is going to make sure there's nothing in our way, giving us that clear path. When these rules are met, you're going to turn your attention to a smaller, faster chart. It's going to take that one bar, that most current bar, and it's going to dissect it, kind of give you an X-ray. And you're going to see 15 to 30 bars. We're really just going to refine that broad stroke of a brush, and we're going to pinpoint exactly where the market is most likely to continue. And by doing so, by using this refinement chart, what it does is it allows you to reduce your risk. And by waiting for a pullback, it's going to allow you to increase your profit potential. And we use these two charts because they're very much just a representation of the forces in the market, guys. The large chart, sorry, I'm a little antsy. Too much coffee. The large chart represents the large crowd, the people in charge, the people that create trends, the people that establish momentum, all the people that are reacting to those very key areas that you're going to see on your charts. And then there's always a small crowd. There's always this group of yahoos that want to fight the large crowd, these people that want to say, hey, I know you're going up and I know there's a lot of strength, but we feel like maybe we should push down. And we love these guys because these guys are our refinement process. These are the guys that push us right back to the best of the best areas where you guys can get in and really put together that entry that reduces your risk, that maximizes your profit potential. So we're going to keep it very simple today. We're going to keep it very focused. And I have to go through this same way I go through it every day, guys. Your step-by-step path to becoming a confident trader ASAP, the easiest way, the fastest way to do it is post in the room, guys. Everything. Everything that you see, if there's a question, post it in the room. If you take a trade, win, lose, or draw, post it in the room. One of the great things about this classroom and what we do is that you have the opportunity to have a private session with me every time you post in the room. We're going to look over your advantages. You're going to show me entries. You're going to show me exits. You're going to talk about what you saw. And the more you post in the room, I'm going to tell you right now, the people that post the most are the people that typically end up where they want to be the fastest. So when you are annotating a chart, guys, when you're dropping it in the room, the goal is for you to get the best feedback. And you have to tell me what you're reading. Have to tell me what you see, what you think, what you feel. Give me the opportunity to really get in your head, and we'll make sure that your reads are correct. We'll make sure that your assessments, that your analysis is in line with what the indicators are saying. Make sure that on your large chart, you're talking about momentum. You're talking about your path. Show me the timestamps on the bottom as well as the prices, because we are going to put those two charts together and make sure that both the large chart and the small chart are working together to give you the highest advantage. Show me your entry. Show me your exit. Sometimes you're going to show me an early entry. We're going to work together getting you in the right entry with less risk. And sometimes you're going to show me a late entry. And we're going to see, well, maybe you were out of the room. Maybe you were fearful or uncertain. And we'll address all these things, guys, with just a simple display in the room. And then the second part is use your spreadsheet. Nexgen provides you a spreadsheet. It's in the Nexgen Study Picks folder. And if you go to the trading guide, I think it's right here. There is a link for the spreadsheet. If you want to start fresh, this trade tracking sheet, I'll give you the link. You can grab a brand new, fresh, unmolested spreadsheet, or you can steal this one that I'm putting in the room right now. This is my spreadsheet, guys. I update this every day. Every day I give you my updated version. And there's 4 tabs. on this spreadsheet. The fourth tab, we'll start at the back and work our way forward. This is all the pictures that I've taken for class, all the pictures that I've stolen from you guys, putting in great pictures. It covers those likely to stop areas. It identifies patterns in the market. Some of them bring you success, and some of them rob you from success. But what happens is the more you're reading charts, the more you're going to see these patterns. There's a whole section dedicated to management. You adrenaline junkies, there's your NASDAQ. The green section is about 300 plus pictures that I've taken from you guys in the room. Pictures of high probability trend trades, pictures of what we call a medium probability trade. There's a lot of great entries. There's a lot of great management. And there's also some entries that were absolutely perfect that simply didn't work. And they still made their way in because all we do is we trade patterns. We trade statistical advantages. And the patterns never change. And anything that wins 70 to 80% of the time, you're prepared to take these losers. So we're focusing on execution a lot. There is very mechanical management for beginners. There's also entries going long and short for the high probability trend trade. And that's your fourth tab. Your goal should be to make the third tab look like mine, guys. This is the exact same setup. And this is where you're going to put your pictures as you develop your trading plan. Um, and like John Novak just said, a new user should study those perfect trades. They should open each picture, see the commonality, is that a word, in those trades, and you get it quickly. And John, I'm going to cover that, so thank you for your help there. Your second tab is the 101 tab. Guys, this is where each rule for the high probability trend trade has been broken down. The green background represents rules being met, and the red background represents rules not being met. I'm going to give you a document that really gives you a game plan for using this to get to where you want to be the absolute fastest. And then finally is the first tab, and this is your trade journal. This is where you are going to be able to post every trade that you take. This is where you're going to be able to put in your trades and write how you felt, what was going on. And there's also an entire section dedicated for feedback. So whatever feedback you get from the room, from posting in the room, drop it on your chart, drop it in your notes section. And the whole idea for this first tab is that you're going to come back every morning and you're going to study the previous day's trades. You're going to ask yourself what worked and what didn't work and what felt easy and what kept you relaxed. And you're going to find a correlation between the rules being met um, and that very relaxed, that mellow feeling. And when you find yourself breaking the rules, taking chances, wishing and hoping, you're going to notice that it feels a little forced, that it makes you nervous, that those butterflies show up. And a brief historical study, guys, each morning, pour your coffee, load your charts, look at what you did yesterday. It's going to get you right for the day. You're going to be able to use these notes, right? Don't miss this setup. All right, I'm focused on that setup today. Or don't trade into a termination condition. I'm really going to look for those termination conditions. And the more you use this spreadsheet, guys, especially when you couple it, take the pictures, draw them in the room, get the feedback, get them into the spreadsheet and study them. Don't just let them go there to die. It pays huge dividends. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. This is the first part of every classroom, guys. We're going to break down each individual rule. We're going to be able to identify it. We're going to take pictures of it. We're going to talk about why it's an advantage. And we're just going to really focus on that basic foundation building. Simulate, practice, break some eggs. Get in there and pull the trigger, guys. If you're brand new and you think you see a trade, take the trade. If you think you see an opportunity, take it. It's okay. You're on simulator. But make sure that you're posting them in the room. Make sure that you're getting the feedback. Make sure that we're talking about what you see, what you did. Because the goal is that you always practice the correct rules, that you're not just trying to get lucky, that you're not trying to build up this simulated account so you can have a simulated house and a simulated Ferrari. Because what happens is when you practice aggressively, when you practice outside of the rules, when you're taking chances, you're teaching your brain to take those chances. You're creating muscle memory, and it typically sets you up for long-term failure. We're going to simplify. We're going to talk about that high probability trend trade. We're going to talk about what's called a medium probability trend trade. So a high probability, everything agrees. Medium probability, what happens is almost everything agrees, but there's going to be an issue. Your ability to read charts will identify that issue. These are managed a little more assertively. Once again, your ability to read charts is going to allow you to manage them assertively. You're going to be able to recognize problems. You're going to be able to get to a zero loss. But the key is you really have to make sure that you understand what it looks like. The easiest way to understand what something looks like, to make it effortless, is to go back and look at these pictures when there's nothing going on. Click on a picture and say, all right, this is the perfect trend trade. What's it look like? Well, I notice momentum and there's nothing in the way, and I see where he entered, and man, there's all these great opportunities here. So when I'm looking for a high probability trend trade short, my chart should look like this. And that's kind of the goal, is to get you to the point to where you can really just pick these trades out, and not hesitate, and um, not overthink it, right? Keep it simple. So we're going to use the two charts, large chart, small chart, and we're going to focus on the three rules, guys. And the three rules start with strong triggers. And understanding strong triggers, recognizing strong triggers, goes back to understanding that trend. If the background is green, the market is going up. And the easiest way to recognize strong triggers is both your small triggers. Good morning, Kenan. Both your small triggers and your large triggers, solid lines, dashed lines, need to be green. All the colors should match. And when the small triggers break above the large triggers, when there's space created between the two, this is what we call a strong trigger look. And strong triggers look pretty much the same both directions, just inverted. When the background is red, small's below the large, space created. It's that space between the large and the small, guys, that lets us know that the odds are favorable for the market to continue up. It lets us know that the odds are favorable for the market to continue down. And when you have what we call odds favorable momentum, this is the best of the best time to buy Fibonacci support on a smaller, faster chart in that uptrend, or sell Fibonacci resistance on that smaller, faster chart in an uptrend. And on your large chart, that slow chart, that freight train that's just ambling down the track kind of thing, you're going to see a tail. You're going to see a wick. This is that broad stroke of a brush. But on that smaller chart, it's a pushback and it's a bounce. And you're going to be able to pinpoint really within your first 30 days, I think, probably sooner if you go through the study process. You're going to be able to pinpoint exactly where these wicks or these tails are most likely to form using that smaller, faster chart. So for the brand new user, odds favorable momentum, guys, it is the best of the best look. It's the one that lets me know that a market has the potential to continue in the direction. So we're going to turn this into a screencast lesson as well, or a capture software lesson. I'm going to take a picture of my S&P large chart. I'm just going to click on that capture button. I'm going to click again, and it's going to give me the option to take a picture. Once I do that, it's going to give me the image preview. This is how you and I are going to have a conversation every day, guys, is you're going to use this chart. So what you're going to be able to do is use these arrows, these callouts, these shapes, and they're all click and drag. So if I left click and drag down, I can get an arrow. And if I left click and drag down, I can get a box. So if I left click and drag down, I can create a text box. Make sure that your cursor is blinking in there. If it's not blinking, if you click somewhere else and it goes away, you're going to have to double click. But guys, this is where you're going to give me the whys. This is where you're going to tell me what you see. So for example, here, you're going to say that the smalls are above the large. You're going to say that this is odds favorable momentum. You're going to say that this is rule number one, strong triggers, and you're going to say that I have the advantage of momentum. You're going to go through this process, not only identifying the look, why it's the look, what it means to you as a trader. Once you have that, you can hit the copy button down here in the bottom right, come over to the live chat room, drop it in, and say, hey, Mark, I want to make sure that I'm identifying strong triggers correctly. I know that this is the first rule. I know this is important. Did I get it right? And you'll get the feedback. I'll say, absolutely, those are strong triggers. This is the advantage of momentum. And man, when you have these strong triggers, this is the best of the best time to look for a pullback on a smaller, faster chart to pinpoint where this tail is most likely to form. And that feedback is going to help create the recognition. And guys, look at this. There's strong triggers. There's strong triggers. There's one of those tails. There's strong triggers again. And the market continues.
Order filled.
You can also hit that upload button. And it's going to upload the media to screencasts. It's going to give you something in the cloud. We're going to use this. We're going to copy that link. You could drop that link in the room if you want. That's fine. We'll take a look at it. But this is where I'm going to go back to my 101 tab. This is where I'm going to right click and I'm going to drop that link in there and I'm going to say this is strong triggers. And guys, I'm already 26 pictures in this.
Order filled.
So you've got this. Make sure you go through and study these. And capture software, guys. This is how we have a conversation. Capture software is how you and I are going to get you comfortable with everything that you're seeing. Is everybody good with strong triggers? I like to ask a lot, guys. Are you okay with strong triggers? Smalls above the large, smalls below the large. This is the best of the best, guys. Strong triggers pushes a market. Strong triggers can break those key areas. Strong triggers will even cover the mistakes that new users typically make. And then once you understand strength, well, you understand that strength doesn't last forever. And this is kind of a life cycle of momentum, guys. Up here is odds favorable, best of the best. Let's pinpoint where that tail is most likely to form. Brand new users, this is your look. But with both triggers down, when one of the small triggers is inside of the large triggers, this is the first sign that momentum is slowing. You can see the small triggers working their way in. Short trades can still be taken, but you're going to have to be a little bit of a chart reader. You're going to have to make sure that the other charts agree. And then when the small triggers work inside of the large triggers, guys, you have a weakening or a slowing of the trend. Everything is visual, right? Strength, weakening, holy crap, it's weak. And anything can happen is a term that you're going to hear in the room all the time, guys. Hey, Casimir93, welcome to the room. Weak triggers mean anything can happen. Anything can happen means that it may retrace higher. It may reverse. It might still go down. If you're going to take short trades with this look, you have to be aggressive. They have to be managed well. And being a chart reader is what allows you to do that. So for the brand new user, this is your look. You'll work your way into this one. Maybe you'll end up with this one. And these weak triggers, when they reach areas, and this is our segue to rule number 2, this is when these areas are more likely to hold. This is when these areas may create a big untradeable bounce. And that's what rule number 2 is, guys. Rule number 2 is termination conditions. And termination conditions may stop the market. Termination conditions may create that untradeable bounce. Termination conditions are a big red flag saying no more trades into this area. Termination conditions are where these guys make decision, and you know about them long before you get to them, guys. You're going to see these lines on a large chart, and you're going to say to yourself, man, these people that move the markets, these ladies and gentlemen that push and create trends and establish momentum, well, they might exit at these areas. They might take a leave at these lines. They may fight one another when they reach these areas. So potential termination conditions are nothing more than lines on the large chart. We're going to look for divergence highs and divergence lows. Magenta dashed line coming from a pivot that's lost momentum. Magenta cyan line, which is just a fancy way of saying light blue. From a low pivot, you're going to look for red Fibonacci resistance, blue Fibonacci support, yellow 1-to-1s, and sometimes the mid band. And ultimately, guys,
order filled.
Trigger lines, the same trigger lines that establish momentum are going to let us know if these areas are likely to stop the market. That's your termination. Have the potential to break. That's going to be your medium probability scenario, or have broken and everything is wide open to get you to the next area. And it's a really simple recipe to understand. It begins with price reaching the area. Price reaching the area sets off the decision-making process. And when price reaches an area, in this case support, all you have to do is ask yourself, where are my trigger lines? And if your trigger lines remain above support, no more short trades. That's it. It's really that simple. Price reaches the area, the decision-making is set off. If the triggers are above, pump the brakes. It's okay. You don't know what the reaction is going to be. You don't know if the sellers are going to push through. You don't know if the buyers are going to try to take over. And you don't know if they're both just going to sit there and fight for the next hour. So if price reaches, triggers don't break, sit on your hands. And then when is the path clear? When the small triggers and the large triggers, both lines of both, get through an area. In this case, they happen to break through support. Whoops, that's
Order filled.
and small and large get below, the area is considered broken. And it has nothing to do with the color of the fib, guys. It has everything to do with trigger location. Small and large break the area. Support is now broken. It becomes resistance. You have odds favorable momentum. And on that most current bar, you guys are pinpointing that tail right where the market is most likely to continue and riding that wave of momentum all the way down to Fibonacci support. So there's three options. There is price reaches Fibonacci resistance, 69.80. My small and my large triggers are both below the area. Therefore, I'm not taking any trades into this area. The area is not a clear path. It's not broken. All the momentum in the market, my small triggers absolutely smash through the area. Look for 3 to 4 points of push. Odds favorable momentum, but my large triggers are lagging behind, which means that 69.80 has the potential to break, but it's not a clear path. Rule number 2 isn't met. And then once my small and my large triggers get to the other side of resistance,
Stop filled.
and the path is now clear until I reach the next area. There's one of those tails with odds favorable momentum. Brand new users, let it be easy. Let it be broken. Let it be clear. Eventually, your ability to read charts will take you to that next level. And if you go back to the live market, and I'm going to do this right now, large chart again, you're going to see some pretty cool stuff. You're going to see a resistance that stops the market cold. You're going to see yellow one-to-ones that creates an untradeable bounce. You're going to see how support is the bounce point for continuation up. You're going to see how rule number 2 can identify a consolidating market waiting for breakouts. The beginning of the move down starts at resistance. Divergence lows create a bounce up. So going back and really studying this look and looking on the large chart, you've got 10 days worth of history on your large charts. Go back and look at all 10 days. Go back and say, man, look how often the market stops in its tracks when it reaches an area and the triggers don't break. Or look at how momentum gives these areas the potential to break. And there's one of those tails, one of those potential entries. But I also want you to recognize what I think is one of the most important things is that rule number 2 very often is going to keep you out of trouble. Rule number 2 is going to remind you that 90% of your day is spent reading indicators. And I'm going to show you how that works. Odds favorable momentum. The market is screaming. Everything is going down. And really, maybe you're in a short trade or maybe you have a little remorse that there wasn't a short trade to be had. That momentum absolutely smashes through Fibonacci support. Everything is going down and there just was an opportunity to take. It reaches these yellow one-to-ones, and some of you are going, I didn't make a penny on the way down. I'm going to trade into this area where the triggers are above, and it doesn't work out. You're stopped out almost instantly, a big untradeable bounce. And this bounce goes all the way to resistance, and all the triggers remain below, and you're like, man, I can't go short, I can't go long. And you notice that your trigger lines don't match each other, and they don't match the background. You're like, I don't have momentum. I don't have a clear path. The market is just bouncing back and forth, and there's nothing for me to do. And guys, this is your 90%. This is where doing absolutely nothing when there's nothing to do pays huge dividends. And it's not uncommon to see people that are a little antsy, that don't want to wait, lose 500, right? Lose 1,000. Get rid of $1,500 from their accounts, blow out, get angry. When rule number 2, the whole time, rule number 1, the whole time is just telling you, sit on your hands and do nothing. Eventually, if you allow it to, you end up with momentum. The smalls are outside of the large. And you'll notice that both the small and the large get above resistance and it's acting as support. And guys, there's one of those tails with the rules met. This is the entry for your highest probability trend trade. This is the trade that typically wins 70, 80% of the time. This is the trade that creates confidence through the memory of success, guys. And this is the trade, this particular trade, was about a $450 trade. And that feels good, guys. That's a lot of confidence. But if you lost 500 chasing trades that didn't exist, you're still down 50 bucks. You're still down 550 bucks. You're still down $950. And all of your amazing analysis goes to waste because it's making up for the trades that you shouldn't take. So termination conditions, guys, they're going to use lines on the large chart. Termination conditions are where the key players in the market are reacting, whether it is support, resistance. These lines can be used for targets. These lines can be used to keep us out of the next trade. Is everybody good with that? And I always ask that. Lines on the large chart. Are you guys okay with the idea that this is where termination conditions happen, guys? This is where it's okay to be patient, where it's okay to say to yourself, man, I just don't have the advantage. Cool. Sometimes your large chart doesn't make it to support or resistance. Sometimes it has a clear path. Sometimes it has a clear path and momentum. I'm going to give you guys one more termination condition here. And this termination condition is going to be the only small chart termination condition. The only time where I'm going to say on a small chart, I do not have a clear path and my rules aren't met for a high probability trend trade. And it's going to use the idea of divergence, guys. Divergence. We all love to overthink divergence. Divergence is nothing more than a loss of momentum. Divergence means that when, we're going to use some arrows to show this, that when price came down and went back up, right? Price comes down, goes back up. This is what we call a pivot. And a pivot is just a little change of direction in the market. When the market goes up and comes back down, there's a pivot. What divergence means is that at this pivot, momentum didn't follow. Yellow represents momentum. Momentum is lagging behind. Momentum can't keep up with price. And it's going to print a negative number. And I'm going to tell you right now, the negative number means squat, guys. It doesn't mean anything. It's just a byproduct of the calculation. There's going to be a negative number and a cyan line from a low, and then a negative number and a magenta line from a high. This loss of momentum, when you see it 3 times, no matter what the time frame, is a termination condition. It may reverse the market. These 3 divergences become even more powerful when your small triggers work their way inside of the large triggers. It's the exact same lesson from rule number 1. Smalls outside of the large means odds favorable momentum. Smalls inside of large means anything can happen. So now you have 3 losses of momentum and you have weak triggers. And it becomes more powerful still, guys, when that third divergence is higher than the second from a low or lower than the second from a high. You're going to see this on that smaller, faster chart before you ever see it on that larger chart. And this look at a low or this look at a high not only says don't take that next trade, but it's going to help you see when that large chart may be changing direction and it's just too slow to give you that information. So this is my only termination condition on a smaller, faster chart. You'll see it on every time frame. If you see it on a higher time frame, it's even more likely the market's going to reverse and push the other direction. So as of now, we have momentum. We have a clear path. Rules 1 and 2 are met on the large chart. Guys, it's time to go to the small chart. It's time to let the small crowd do their thing. The large crowd says up, green background. The large chart says odds favorable momentum. There's that separation between the small and the large, and the large chart has absolutely nothing in its way. This is where the small crowd comes in. This is where these fighters come in and they say, you know what, I have just enough money. I'm going to mess with you guys. And they create what we call a pullback. It's just a small retracement counter to everything over here. This pullback is what gives us the magic of rule number 3. Rule number 3 says you're going to use a limit order. You're literally going to call your shots, guys. You're going to know exactly where the market is likely to continue, and you're going to have an order waiting there. You're going to use a limit order to buy or sell a pullback, that little shove from the small crew, and you're going to do it at an area. So large chart lines may have been problematic. Small chart lines give us something to bounce off of. But the thing is we want those areas to be inside, for the brand new user, what we call favorable large triggers. For the more established user, we'll just say triggers. And I'm going to show you the difference between the two. On your small chart, there's two sets of large triggers, is the easiest way to say it. There are the ones that are native to the chart, and they tend to be smooth, and these are the ones that you'll use to establish momentum. And then there's the synthetic triggers, these more stepped triggers, and they are nothing more than the large triggers from the large chart. We superimpose them onto the small chart because there is a huge advantage of having those triggers trending together, one on top of the other. Trigger lines are moving averages, and price loves to return to a moving average. It loves to snap back and come to those trigger lines. When you put a couple areas inside of there, it gives it something to bounce off of. So favorable large triggers means that your large and synthetic are one on top of the other, two snakes riding piggyback. This is your best of the best look, new users. This is where it's easiest. This is where there's going to be the least amount of risk. And it's the absolute effortless pinpointing where the market is likely to continue. Sometimes, as trends slow, as change happens, you'll see the large and the synthetic begin to separate or split. You're going to hear me say split triggers in the room a lot. When they do, essentially you've created two correction points. Price may correct to the large triggers. Price may correct to the synthetic triggers. The reality is we don't know. Hey, good morning, JW. And it increases your risk and it decreases the accuracy. As you grow with the software, as you begin to get your reps, as you begin to understand a couple patterns that repeat themselves, you'll know when it's okay to take a trade with these split triggers, or you'll wait for a little confirmation. But for the brand new users, favorable large triggers is the best of the best. And then we're going to get into two snakes riding piggyback. I like it, John. We're going to use that two-chart process, guys. We're going to pinpoint exactly where the market is most likely to continue, but everything starts on the large chart. Large chart leads the way, guys. And the large chart, and I hope everyone can see it, has strong triggers. And the large chart has the small and the large triggers above resistance. It's now behaving as support. The path is clear. And there's a circle, well, a square, right around the tail. And this is where we're going to put it together, guys. We don't trade tails. We don't wait for these tails to form. The top of the bar, the most current bar, what we're doing is we're learning to study right now. The very top of the most current bar is going to be the beginning of your pullback. And in a perfect world, when everything works out, guys, that tail, that wick, is going to be areas of support inside a favorable large trigger. So we're not waiting for the tail to form. What we're doing is we're watching our small chart when the rules are met. And the first thing we're going to do is wait for a reversal bar. A reversal bar signals the beginning of the pullback. A reversal bar is not your entry. It says, let's put the wheels in motion. Let's start looking for the best of the best spots. So when the reversal bar prints, I start looking for my favorable large triggers, for the large, for the synthetic. They should be overlapping, one on top of the other. And then once I've identified my trigger lines, well, now I have to find, sorry about that, those areas within. I have to find fibs, mid-bands, yellow one-to-ones. When price reaches my trigger lines, this is not my entry. Trigger lines are like clouds. I don't expect them to create a bounce. Areas inside of trigger lines are like a brick wall, and we're just throwing a tennis ball as hard as we can. I don't expect it to ricochet off of nothing. I need something solid for it to bounce off of. So we're going to create what we call the window of opportunity, the woo, if you're a Ric Flair fan. And that window of opportunity is going to extend from the highest point of support, fibs, mid-bands, yellow one-to-ones, to the lowest point of support, fibs, mid-bands, yellow one-to-ones. It doesn't matter which it is. We don't rank it. Lines inside of triggers give us a bounce point. So you're going to draw a little box from the highest point to the lowest point inside of favorable large triggers. This is where the market is most likely to continue. This is where we anticipate a bounce. I'm in the books, finally, right, Paul? I'm a somebody. You're going to activate your limit order right at the top of the window for a long trade. And why are we at the top of the window for a long trade? Because your large chart is screaming to the upside with absolutely nothing in the way. And we just don't expect the small crowd to get a lot of work done, not against this level of force. So your entry is a limit order just above that highest point. And you're just going to wait. And it's either going to hit you or it's not. And for a short trade, it's the exact same thing. Everything begins with a reversal bar. The reversal bar starts the pullback. The entry is not the reversal bar. This is just setting everything in motion. Where are my triggers? Red box. Where are the areas inside? And guys, this is one of those magical moments where there is one line inside of favorable large triggers. There is one point where we expect this market to bounce. Your limit order goes just below it. And this is your entry.
Order rejected.
Probability trend trade. And you're going to have to train your brain
Order filled.
that these areas outside of trigger lines are not the best of the best. These are not the points where we expect the bounce, because we expect price to correct to triggers. We expect price to bounce off the areas inside the triggers. So you're going to train yourself to ignore these lines above the triggers. You're going to train yourself to ignore these lines below the triggers. And guys, I want you to take 30 days. Focus on the best of the best. 30 days being able to identify the absolute highest probability trend trade entry. And everything starts with a large chart. Rules met, strong triggers, clear path, large
Stop filled.
We want this market to go down. Dare somebody to fight us. So step one is waiting for the reversal bar. And once you get this reversal bar, you're going to set things in motion, guys. You're going to identify your trigger lines. Are they wide? Are they angled in the direction of the trend? Are they overlapping? And once you find your trigger lines, you're going to say, what are the areas inside? I'm looking for fibs. I'm looking for mid bands. I'm looking for yellow 1-to-1s, but they have to be inside of the triggers. I'm going to create a window of opportunity, that point where the market is most likely to bounce. And once I identify my window, the only thing left for me to do is just activate a limit order. That's what the yellow line is right here. I'm activating a limit order right at that lowest point. And I'm saying to myself, I sure hope the small crowd gets there. I've done everything that I can do at this point. I have insisted on momentum. I have demanded a clear path, and I've pinpointed my entry area. And that small crowd is either going to get you or it's not. But the cool thing is that if they get there, if they give you that push, guys, you're in the market where the market is most likely to continue. You have the advantage of odds favorable momentum of a market that's likely to continue to push down. There's nothing in the way to create any bounces, and you've entered where the market is most likely to continue. Guys, this is your best of the best. Give me 30 days of identifying this entry. Give me 30 days of picking out this window, and it's going to pay dividends that just, they're insurmountable, right? Because now you understand momentum, and now you understand a clear path, and now you understand entry points. And once you understand entry points, you understand where the market shouldn't go. Once you understand where the market is likely to go, you understand where it shouldn't go. And this is going to be your first stop placement. This is going to be generally 4 or 5 ticks above that window of opportunity, above those trigger lines. And you're going to say to yourself, if the small crowd pushes past my window, I don't want to be in that trade anymore. I no longer have that edge. I don't have the advantage of the entry area. I'm just going to exit. I'm going to take my hickey and I'm going to walk away. And you have to remind yourself as a brand new user that anything that wins 70 to 80% of the time, it's mathematically obligated to lose 20 to 30% of the time, guys. This is a cost of doing business. This is nothing more than allowing the market to be wrong. And these stops are going to reduce losses dramatically, guys. Having momentum is the first step in management. Having a clear path is the second step in management. Getting in where the market is most likely to continue is a third step in management. All those advantages are designed to reduce risk. And then this is the final one where you just say, hey, if it goes beyond the good stuff, I don't want to be in it. And then with all those advantages, more often than not, you're going to get a bar in the direction of your trade, and you're going to reduce risk even more, a couple ticks above, a couple ticks below. And it's not uncommon or unusual at all to see you guys post in the room taking a rules met, perfect high probability trend trade, using that reversal bar, reducing risk dramatically, and only losing $30, $40, $50 on a trade rather than saying, man, I sure hope it goes up. I sure wish it would go up, and getting stopped out for $200 to $300. So odds favorable momentum, guys, clear path, pinpointing where the market is most likely to continue. This is setting things off. This is getting you exactly where you want to be as a brand new user. This is getting you to where you can read your indicators. And just for grins, we'll circle this one right here. And I'm going to minimize this chart. I'm going to go back to that tail. That's just the one that stood out to me. And I'm going to backpedal on my small chart until I see that circle. And what we're doing is we're learning to study. We don't trade the tails. We trade the pullbacks to support right there at those triggers. Notice how the two line up. Your job is to pull out your capture software, click that big red button. Don't just hover over one chart. Make sure that we get two charts worth of information. Click and drag from the upper left all the way to the bottom right, making sure that we get timestamps, making sure that you get the prices, and then snap in that picture. And when you snap that picture, you're going to say things like odds favorable momentum, right? You're going to say, not troggers, we're not looking at the troggers, guys. Triggers breaking area with strength. And you're going to say something clever like pull back to area inside the favorable large triggers. This is my trade. This is what I want to do. And once you take your annotations, hit that copy button, drop it in the room. Say, hey, Mark, I want to make sure that I did this right. I want to make sure that I'm not messing up these great lessons. That is strength, right? And this does have the potential to break. And that's the mid band inside of those triggers. That's my trade, isn't it? And I'm going to be like, heck yeah, great job. Upload that thing to screencast, right? Copy that link. Go to your spreadsheet.
Stop field.
Hey, man, oh man. This is my high probability trend trade. This is the trade that gives me the highest chance of success. This is actually a 50-50 trade, which is that second trade, that potential to break trade. You guys get that into your spreadsheet, get it into the classroom, get that feedback on it, and take this afternoon and just keep scrolling and look for your rules to be met. Look for odds favorable, right? Look for one of those tails. Maybe even in the beginning, don't even worry about the clear path yet. Let's start building trust and momentum. And what you'll find is that this is a pattern that repeats itself all the time, guys. This is a pattern that gives you the highest chance of success. And this is your focus for 30 days. To be able to recognize this in the moment, look at that, 3 divergences in the same price.
Order filled.
And it pushed that market up. And I love rules. To be able to really recognize this, to be able to check this out and get it the best of the best, you have to pinpoint a couple looks, right? You've got to understand odds favorable momentum.
Stop field.
Know what strong and weak triggers look like. You've got to know what a termination condition looks like. You've got to know what a clear path looks like. So this is the first of about 5 documents I'm about to drop in the room, guys. This is your 101. Chart reading 101. In order to get to where you want to be, you've got to recognize some looks and patterns quickly because you want to just commit them to memory and then it becomes easy. So take 25 pictures each, guys. Strong triggers, weak triggers, clear path, termination conditions, 50-50 lift, like everything. And don't just take the picture. Do me a favor. Take a picture, annotate the whys. Annotate why it's strong triggers. Talk about what it means to you. Talk about what's the formula for finding that termination condition. Take these individual pieces, identify them, draw the pictures, show why this is what it is, what it means to you, how it fits into your trading plan, and take those pictures and start filling up this 101 section, guys. I've given you a huge head start. But if you take these pictures, if you annotate these charts, if you learn to piece these individual things together to create a trade, what you're going to do is you're going to be able to pick apart almost instantly how to catch these trades, what it looks like, what the advantages look like. And this is really the first thing, guys. This is the first step into confidence building. This is the first step into understanding what it is that you're looking for and how it is you're going to find it. And if you go through this, I haven't had anyone do this yet and not turn out to be a better chart reader. The next thing you're going to need to do is maybe have a way to police yourself as you take these pictures. This is a high probability trend trade checklist. This is a checklist that shows you exactly what it means to have a termination that reverses the market. This is a checklist for the entry that shows you odds favorable momentum, that shows you those anything can happen triggers, that talks about terminations, potentials to break, and clear path. and that identifies the window of opportunity. Use this one as your cheat sheet as you go through and do that chart reading 101. And then here's the same version without the pictures. This one can be printed out. It can be put on your desktop. You can police yourself every time you take a trade. And you can say, did I have a good top or bottom, a termination that reversed the market? Was there odds favorable momentum? Were my termination conditions false? Did I have an area inside of favorable large triggers? And if the answer is yes all the way down, guys, I've never had anybody in the history of this checklist do worse than 70%. This is your path to building confidence, to having the ability to be profitable while you become a chart reader, guys. So that's where the final document comes in right here. This is the KISS plan, the Keep It Simple Sunshine Plan. And I just put all four in the room for you. This is a stepping stone. I got to wet my whistle for this one. This is a stepping stone in your learning journey. This is a path from your foundation, guys, and it's designed to optimize your chances of success with the high probability trend trade, with a 50-50 trade, that area with the potential to break. But it's going to be through simulation, through study, through feedback, continuous practice, that you're going to be empowered to create a plan that is tailored to your personal goals based on your ability to read your indicators, which is an AI-generated fancy way of saying, guys, when you can read your charts, you're going to see a million opportunities. You're going to see so many opportunities in the market. But your simple plan for consistency as a brand new user, the easiest way to get to where you want to be, never fight the large chart. Never fight the large crowd. Don't jump in front of that freight train, guys. And this was put together by my brother a while ago. It's a tongue-in-cheek book, How to Commit Financial Suicide, One Easy Step. And chapter one is they're trading against strong triggers. They're fighting momentum on that large chart. Chapter two is they're trading in determination conditions. He put this together because in 27, 28 years of teaching people to trade the markets, these are probably the two most common problems. Just believing that your opinion is going to outweigh all the forces of the market. So commit to that and then define your entry. Define where it is that you're going to get in, that best of the best spot, guys. And there's the checklist again. I've included pictures for your trading plan so you know exactly what it looks like. And defining that entry is really the first step in management. So once you get in, you have to manage. You've got to do something with that unbelievable entry with all those advantages. And what we found throughout the history of teaching people to trade, is that the more mechanical your entries are, the more mechanical your management is as a brand new user, the more if-then, the easier it is to get to where you want to be. That simplicity really yields results. So your mechanical management beginner plan, guys, the first off, the best of the best, the easiest, is 100% dependent on getting in where the market is most likely to continue. Stops and targets provided by Nexgen are 12-tick, 24-tick scenarios. If you are trading the S&P, if you're trading crude oil, your default stop loss is 12 ticks, but 12 ticks is only designed to give you reaction time. 12 ticks in this particular trade is up here, but it's still inside the window of opportunity. So your initial stop goes where the market should. Your initial stop is there, and there's only one of two things that's going to happen, guys. It's either going to hit your stop,
Order filled.
or be stopped out. It's a normal part of a positive equity curve. It's okay as long as the execution was there, or it's going to give you that reversal bar in the direction of your trade. Once you get that reversal bar, if the reversal bar prints, then I will move my stop.
Stop filled. Stop filled.
Or a long trade, 2 ticks below it. And there's nothing for me to do. I've got to sit on my hands, right? Hands in the air. It's either going to hit that stop, it's going to take a smaller loss, or it's going to move on to my first target. And for you guys on the KISS plan, your first target's only $100 in the distance, guys. It's only $100 away. And your first contract comes off at that first $100. Once that's off, that's your money. This is where confidence is built, guys. This is success. Confidence comes from the memory of success. And you're also going to put your stop at break even. And that may not be the best stop, but as a brand new user, It takes all the risk off this trade. You've already been paid. You've got nothing to lose, and it's going to make it easier for you to hold for the second target. The second target is only $100 from the first, which makes it a $200 target, which means that if you hit it with all that momentum, with that clear path, with that beautiful entry, with that reduced risk, guys, this is a $300 trade. And some of you believe that you need $1 million to do great things on the market. Yeah, I've got to make $10,000 a day or I'm never going to be successful. Guys, $300 a day is a
Order filled.
$1,500 week, guys, and that's a $6,000 month. And that's a $72,000 a year, adjustments here and there for holidays. But guys, $72,000 a year, right? What if you turned it into a 4 lot with the exact same management and it turns into 144,000? And you continue that compounding as your confidence grows. Everything stems from keeping it beginning.
Stop filled.
Indicators. Learn to recognize advantages. Learn how to get paid. Because that is the goal of what we do, guys. The goal is to get paid. And then your management, just like your trading plan, you will craft a plan tailored to your goals based on your ability reading the indicators. You're going to understand when it's okay to hold for bigger moves, when you should get out sooner. And all of that comes from the repetition, from the pictures, from the study, from the feedback.
Order filled.
And you'll get to a point to where you might say, with odds favorable momentum, with an absolute clear path, I'm still going to get paid. I'm still going to drop my risk. But man, this market says that it's most likely to go down to that fib. What a great place to get paid. What an awesome spot to be able to hold, to turn that $300 trade into a $700-800 trade, and then just call it a day. Go surfing, go play golf, go do something, right? Walk your dog. Take advantage of all the wonderful things that you've done, guys.
Order filled.
First hour, and it looks like we made it into the hour, guys. Be okay with not being in every move. Every dollar isn't your dollar. Every swing isn't your swing. Every opportunity isn't your opportunity. But if you wait for the best of the best, if you give
Stop filled.
statistical advantage each and every time you enter the market, then you become patient and you say that even with momentum, I don't have a clear path yet. And my small chart confirms it with multiple divergences. And it's all right if there's nothing for me to do. It's okay if I'm not in a trade. It costs absolutely nothing to remain flat. And you may say that with strong triggers, right? I'll let this one bounce off with the potential to break. But as I start getting changes, when my large triggers start going the wrong way, when my triggers don't match and they're no longer favorable, maybe I'll avoid this last trade. Maybe I won't take that final long, but it's okay because I already got paid right up to the very top there. So are there any questions about the high probability trend trade? Are there any questions about momentum? Are there any questions about termination conditions? Are there any questions about recognizing that window of opportunity when the conditions are right? Once again, is this the one that we did earlier, or did we do it on the S&P? What did this one look like? I love scrolling back and doing this, guys. It just builds confidence. Son of a gun. Right to a mid-band, right inside of favorable large triggers, guys. Everything that we do is patterns. Everything that we do is patterns. You can take, and I'm going to show you this right now. This is pretty cool, I think. I hope you like it as much as I do. I'm going to go to the trade section, trading guide. I'm going to go to tops and bottoms, and I'm going to show you a picture that's right here in the user guide where price reached resistance, pulled back to support, and weak triggers at resistance is where that market reversed. And I'm going to minimize it, and I'm going to scroll back on crude oil. And I'm going to take that same picture where price reached resistance and pushed all the way back to support, and then weaker triggers at resistance is what reversed the market. This is from today, 5:34 a.m. The picture in the user guide is from 2021. Patterns repeat themselves, guys, all day long. Learn the patterns, become a chart reader, and then being a day trader will become effortless. So, all right. Directly to Fibonacci support, that's your 10 o'clock fib update. You can see it on the small chart as well.